why gold and silver hit record highs in 2026, and what investors need to know. Gold at over $5,000 per ounce, silver breaking past $100. Two metals once considered fringe stores of value are now making headlines like never before. But why are these ancient assets hitting record highs in 2026? Is this a genuine shift in global finance, or is something else at play? Today, we're breaking down the real drivers behind the rally, what it means for you as an investor, and how markets may behave next. Setting the stage, where prices stand in early 2026. Let's begin with the facts. Gold reached historic peaks, crossing the $5,000 mark in early 2026, substantially higher than previous records. Silver, likewise, traded above $100 per ounce, another milestone that would have seemed unlikely just a few years ago. This dramatic rise has captured headlines and investor attention globally. But to make sense of this move, we need to understand what's driving it. The macro forces behind the rally. 1. Safe haven demand in an uncertain world. One of the foundational drivers has been investors seeking safety amid market uncertainty. When traditional assets like stocks and bonds look shaky, many turn to precious metals. In early 2026, a series of geopolitical flashpoints, from tensions in the Middle East to unsettled trade policies, have fueled fear in financial markets. In these environments, gold and silver are classic safe haven assets, stores of value that historically retain worth when other assets do not. 2. US dollar weakness and real yields. Another key factor is the US dollar and real interest rates. When the dollar weakens, gold becomes more attractive, especially to holders of other currencies. Lower real yields, that is, the return on government bonds after adjusting for inflation, reduce the opportunity cost of holding non-yielding assets like gold and silver. Analysts have noted that expectations of future U.S. Federal Reserve rate cuts or shifts in monetary policy have supported precious metals because lower interest rates typically make these metals more appealing. 3. Central bank buying and reserve diversification. Central banks, especially from emerging economies, have continued to buy gold aggressively as part of a strategy to diversify away from dollar-centric reserves. While some data shows central bank purchases dipped slightly in 2025 compared with the heights of earlier years, overall accumulation remains significant and supports a higher price floor for gold. 4. Persistent geopolitical tensions. Political risk is another major driver. Prolonged military and trade uncertainties, such as tensions involving the US, Iran, and other global hotspots, erode confidence in global financial stability. When this happens, investors naturally migrate toward precious metals. This effect has only amplified the recent rally. Silver. A different story. Gold and silver often move together, but the story for silver has some key differences. Industrial demand is exploding. Unlike gold, which is primarily an investment asset, silver has a major industrial footprint. Silver is used extensively in solar panels, electronics, EVs, and importantly, AI data centers. These sectors are expanding rapidly, pushing physical demand higher even as markets remain tight. This combination of safe haven buying and real industrial usage gives silver a unique dual role, making its price swings more dramatic. What the markets are saying. Now that we've covered the underlying factors, let's look at how markets and analysts are interpreting the situation. 1. Forecasts and sentiment. A number of forecasts from major financial institutions point toward continued strength in precious metals. Some analysts even see gold reaching as high as $6,000 per ounce by late 2026, driven by continued macro uncertainty and inflation pressures. At the same time, retail and institutional sentiment remains strong. For example, surveys suggest a large percentage of investors expect gold to trade above $5,000 through the year, underlining broad confidence in the trend. The other side of the coin, volatility and corrections. It hasn't been all straight gains. Sharp corrections and flash crashes, both gold and silver have experienced bouts of extreme volatility this year. There have been episodes where prices plunged sharply due to liquidations or technical market conditions. Silver in particular has seen wild swings, sometimes dropping dramatically before rebounding, a sign of how tight supply and speculative activity can amplify moves. Short-term traders should be especially cautious. Rapid price swings can erase gains just as quickly as they can make them. Should you be buying gold or silver now? Here's where many investors struggle. Now what? For long-term investors, gold and silver historically serve as portfolio hedges, diversifying away riskier assets like stocks and bonds. In an environment of uncertain monetary policy and geopolitical risk, these metals can be a stabilizing anchor. However, it is critical to keep perspective. Precious metals do not generate yield like dividend stocks or interest-bearing assets. This means their long-term return profile depends largely on macro sentiment and inflation, not intrinsic business growth. For traders and short-term players, if you're thinking about short-term gains, you need to account for volatility risk. Prices can swing wildly on news events, Fed announcements, or geopolitical developments. Tight supply conditions, especially for silver, magnify these moves. Risk management is essential, and timing your entry and exit matters more than ever. What the data is suggesting for the rest of 2026, looking ahead, there are several key patterns to watch. Inflation and monetary policy. If inflation pressures resurface, or if central banks pivot unexpectedly, precious metals could remain elevated. Conversely, if inflation cools rapidly and the dollar strengthens, metals may face downward pressure. The balance between these forces will drive price action. Industrial demand. Growth silver's unique industrial demand, especially from tech sectors like AI and solar, could sustain elevated prices even if investor demand fluctuates. Geopolitical developments, political catalysts, such as military conflicts, trade disputes, or central bank reserve shifts, can trigger renewed safe haven buying. Markets remain hypersensitive to headlines in early 2026. So, to sum it up, gold and silver have hit record highs because investors are seeking safety amid uncertainty. U.S. dollar weakness and monetary policy expectations have boosted demand. Silver has additional industrial tailwinds from technology and renewable energy. The rally is real, but volatile, and risks sharp pullbacks. Whether you're a long-term investor or a short-term trader, this is one of the most important macro stories unfolding in global finance. Before you go, here is a question for you. Do you think gold and silver will continue rising through 2026, or is this rally about to peak? Drop your prediction in the comments. If you found this breakdown helpful, subscribe and ring that bell so you never miss the latest updates on markets and investing. Thanks for watching, and see you in the next video.